It's a cheap market, but it can stay cheap for a long time.
Spice, our patriot of the FTSE 100.
The idea is that these cheap stocks at some point increase in price and go back to a higher valuation.
Forget Tom Cruise. You don't want to be a maverick when it comes to investing. You want to be Iceman. Slow, calculated, no mistakes.
As chairman of the board, that seems fine.
Drum roll, please. Chairman, what was the overall performance of the first week of the model portfolio from Art of Investing? Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 6 of The Art of Investing, brought to you by IG, the global investing platform. My name's Rich MacDonald, and as always, I'm joined by CJ and Spice. And today we're going to be talking about the UK. Spice is going to be taking us through why the FTSE 100 has been so disappointing as an investment relative to others. And with 12 new all-time highs this year alone, is there some signs of hope for the future? And we're also going to be looking today at a question from one of you, Matt Carter, sending us in an email saying, really enjoying the podcast, but I've got some cash on the sidelines I've been looking to invest. How exactly should I go about it? So we're going to be going through how you open an account and what the features are on the IG platform. However, without further ado, we go across to find out what the movers and shakers of this week have been in today's Spice Market Update.
As Rich said, we're hitting lots of new all-time highs. The global equities have hit all-time highs, the S&P 500, NASDAQ, and the Nikkei in Japan. Also, Bitcoin, interestingly, managed to make a new high. And now the crypto market's been doing pretty well underneath, is now back to being valued at about $4 trillion, which, if you remember, is the size of Nvidia, give or take.
One stock.
One stock against the whole of the crypto market. The key for these new time highs is being driven by the fact that the earnings from the companies, as you know, we've been reporting the second quarter, have come through much stronger than expected. And so to the point that now earnings are about 10% higher than the forecasts were at the beginning of the year.
Wow.
And that's quite punchy. So it is all about, as we've talked before, expectation management. The US particularly have done an excellent job making people think things are very tough and difficult, and then coming in and smashing the numbers. And, you know, a lot of that has been driven by the Magnificent Seven, as we know.
And of course, that wasn't quite what people were expecting back in April when Trump announced the tariffs. And this week we've seen Donald Trump have a real go at Goldman Sachs because they dared to question that the US economy might suffer.
He doesn't like people who don't give the right message.
Well, if you pay him enough, he'll like you. We know that. Yeah. As Apple have found out by offering another $100 billion and seeing their shares go up 8% in terms of investment. So it's pretty punchy out there. But last night, talking of the world's current biggest company, Nvidia, back in March 2000, the biggest company in the world was Cisco Systems. And Cisco was the provider of all the internet backbone, if you like, for the world. And as we know, the dot-com bubble was brewing and going nicely. Cisco had the results last night. They actually beat expectations, but not great expectation management. The shares fell again a couple of percent. And now we're starting to look at data. So when investors don't have the ability to get updates from companies all the time, they start to look at the economic data comes through. So you'll hear us in the next few weeks perhaps focus a bit more on that than we have done in the last few, because we're moving away from corporate earnings into economics, as it were, and those underlying drivers. So interesting on that front. When we sat down last week, the Bank of England had cut by 0.25%, which is great. They had to vote twice on it, though. It wasn't clear cut. 4 of the members voted for a 0.25% cut. One member voted for a 0.5% cut and 4 others voted for no cut.
How often does that happen, a second vote?
Well, that hasn't happened, I think, since 1993, I think was the last time. So it's pretty unprecedented. But the chairman asked them to revote, and they came back and they got 5-4 in favour of a 0.25% cut, which we've seen. Now, the interesting thing is that, the interest rate cut came through despite actually we had some pretty poor inflation data in the UK. It wasn't great. It was a bit higher than expected. And now inflation is expected to rise steadily over the next few months up to about 3.75%. The core is over 4%. That is going to weigh on their ability to cut further from here. And we'll talk a little bit about when the next rate cuts are expected, and we'll do that for the UK and the US. On the other side, we've had good GDP numbers in the UK this morning, where actually GDP grew by 0.3%, which was a bit better than expected.
And just remind us all exactly what GDP is.
Gross domestic product. It's the way you measure the growth of an economy.
It's the output of the economy over a particular period, and people tend to use GDP as the measure. So when we see numbers going and increasing, then that's really good news.
Okay, and a recession is when it goes negative.
Another bit of poor data, which actually enabled the Bank of England to feel pleased that they were cutting interest rates, was that the unemployment data was a bit worse than expected. So unemployment now in the UK is at about 4.7%. Now, compared to history, that's very low. So Chris and I remember sort of sitting on a train with a carriage of 20 people back in the early 90s. And by the end of the recession, there was basically about 3 of us left. Everyone else has lost their jobs.
I love steam trains.
So yes, we've electrified since then. But back then, unemployment rose to nearly 12%. And we're down at 4.7 now. So that's still pretty good. In the US, we've had some good economic data this week, particularly on the inflation front. If you remember, Chris talked about it in his bond episode, etc. But when inflation is coming down, that gives central banks, the people who set interest rates, the ability to cut interest rates if they want to. And that's basically what the market has jumped on top of this week. And they've basically said, okay, now we expect the Federal Reserve, which is the biggest and most important central bank in the world, to begin cutting interest rates again on the 17th of September, which is when they have their next meeting. Then it's now a 99% probability that they will cut, probably most likely by 0.25%, a 0.25%. But some people now even say it might be 0.5%.
Right.
Because this inflation was a bit better than they expected. But the market are already going, well, when's the next one after that? So the next one they expect now to be in November, when they have a meeting at the beginning of November, and then another one in December. So the US is now looking for 3 interest rates, maybe 4, so 0.75% to maybe 1% off interest rates between now and Christmas. That would be a nice Christmas present for people who have big credit card debts and debts in the US and mortgages, etc. And the markets have jumped on this. They love interest rates being cut. And sure enough, that's what's driven and helped lift the markets like the S&P 500 particularly, and NASDAQ up to all-time highs.
Now, of course, that's the data. But next week, we hear from Jerome Powell at a special symposium, which is outside the normal Federal Reserve meetings, isn't it?
Yes, it's called Jackson Hole Symposium. It happens once a year, and it's normally sort of some big theoretical subject, but it's always a chance for the chairman of the Federal Reserve particularly to stand there and say what he thinks about, his views about the economy and what that might do to interest rates or not. Very quickly, the UK is, as I say, has had this 1 rate cut. The next interest rate cut, those of you who are out there interested, maybe thinking about your mortgages, etc., the next expected cut is meant to be probably there's an 88% probability of another cut on the 6th of November, which is their next meeting. And if it doesn't come then, there's one just before Christmas on the 19th of December. So hopefully the UK will get another rate cut then, which will be great.
Excellent. So, of course, last week we initiated the model portfolio. CJ, give us the update. How's it gone so far?
There's a couple of things I want to get to before we actually look at the numbers. And I think these are important things for us to remember, given the groundwork we've laid over the last few weeks. The first thing to remember is that this is a long-term portfolio. And so whilst reviewing the performance every week is important, it's fun, you can take the mickey out of me, you can do what you like, we've got to give positions time to work. These are long-term positions, and so you shouldn't expect a change every week. We will be changing things, but we've got to give things time to play out as we think they're going to play out. Now, clearly, if we change our mind, if we've changed our fundamental thesis, then we might change those positions. But while we haven't changed them, then we're not going to see much change. The second thing, and I think it's something that Mark and I feel very strongly about, is that people need to understand that the enemy of position taking, the enemy of running your portfolio is emotion. The best decisions are taken when people are calm, they're thinking about things, they're not reacting to events. And if they're doing it at those times, they're going to make sensible decisions. Now, the reason I say that is because all professional investors can think of many times where they haven't done that and things have gone wrong. And of course, then psychology takes over. I've got it wrong. How much money am I going to lose? Oh my God, I can't look at anything else. All I can look at is these prices going down all the time. What am I going to do? Next day, same thing. And in the end, the heart rate's going up and we're thinking, I can't think of anything else. This is dominating everything. And in the end, when you're getting psychologically involved in positions, you do stupid things. You're going to see our portfolio. Events are going to happen to us over the next year, 2 years, whatever it is. At various times, we're going to see big falls, big rises of various things. And what I'm hoping is that by you, the listener out there, seeing how we react to these events, it might help you in your financial journey and these investments that you're holding to make better decisions.
The way I like to think about it, going back to a movie reference like Top Gun, forget Tom Cruise. You don't want to be a maverick when it comes to investing. You want to be Iceman. Slow, calculated, no mistakes. Val Kilmer beats Tom Cruise every time in the investing world.
I think it's a very, very good analogy. And that's exactly what we've got to be, Iceman. Before we get to the portfolio, I just want to mention a little bit on ETFs. If we invest in individual shares, we get a lot of company risk. So if we buy BP, we hold the BP shares. If BP do well, that's great. But if they do badly, they do badly. But the whole index level, the whole of UK market, for example, it's not just BP, it's a whole host of other companies. If we buy an ETF in the UK, a FTSE 100 ETF, we have a bit of every company. And therefore, our portfolio will move like the market as a whole, not as one individual company.
And so what does ETF stand for?
Exchange Traded Fund. The advantage of them are they're very cheap to deal in because they're listed on the stock market, so you can buy them. You can buy and sell them at any time, but they give you the return of the market.
The way I like to think about ETFs is we're all going out for lunch afterwards, right? Now, there might be an a la carte menu, or there might be a menu of small plate dishes. Now, if you just choose one a la carte meal, there's every risk you choose that dish and you're paying £25 for it, and it comes and it either doesn't taste right, it's not what you wanted, not what you expected. If you instead get 6 small plates for the same amount of total costs, you've got diversification. And if there is a big mistake in a single stock investment, such as the BP disaster that we saw in the Gulf of America, then that's a shock, right? And your single stock position suffers. But if you have an ETF, then it's much more diversified, isn't it?
Yeah. And so they've got huge advantages. They give you that diversification of the whole index, but they're very cheap to deal in as well and very easy to deal in. That's all I wanted to say. So let's get on to the portfolio. So rather than me go through the portfolio, I thought Rich, who did a wonderful job last week as the minute taker of the committee, he can go through how things had gone.
Well, thank you, Mr. Chairman, sir. Japan was our best performer on the week, giving us a contribution to the portfolio of 0.18%. Now, what does that mean? Well, that is the total return. Remember, we've only got 10% of the portfolio in the Nikkei 225. So what you do is you take that 10%, we got a 1/10 weighting in the portfolio. So the total return of 0.18% actually means the index went up by 1.8%. You multiply it by 10. Similarly, the NASDAQ 100 was up 1.5% in the week. So that's given us a 0.15% contribution. But then look at the crypto and blockchain innovators ETF. Now, that gave us a performance of 0.12%, but we've only got a 5% weighting. So you actually multiply it by 20 and you find out that that was our real best performer of our positions, going up 2.4% in the week. Now, if we look at what lost us a little bit of money, it is gold. Gold, we've got a 10% weighting, and that was down 1.8% on the week, which takes 0.18% of our total. So, drum roll, please. Chairman, what was the overall performance of the first week of the model portfolio from Art of Investing?
Well, we have a return of plus 0.53%. Now, as I said, don't take too much notice of it because we've only just started. It's long-term investment, but it's better to be up than down.
But you're not retiring.
I'm not retiring yet, although clearly if one annualised that performance, we would easily get to our target levels.
Right in the middle of the pack there, you'll see the FTSE 100 was up 0.8% on the week, giving us a contribution of 0.08%. And that is our specialist subject of the day, Spice, our patriot of the FTSE 100. Take us through the history of this UK index.
So I'm going to look at the UK overall, but we'll ultimately end up focusing on the FTSE 100 because at the end of the day, it is the majority of the equity markets in the UK. There are 5 actual indices in the UK that you can invest in. And you can do that through IG, you can do it through other platforms, etc. But the biggest one is the FTSE 100. And the clue is in the name. It has the top 100 companies in the UK by market capitalisation. Now, market capitalisation is the share price multiplied by the number of shares in issue, and you get a big number. So if you did that for all the shares in the FTSE 100, the total market capitalisation, as it's called, is about £4.8 trillion. So there's a lot of noughts in there. And it's a very big blue chip multinational company index. And about 80% of the revenues in those companies come from outside of the UK. And hence one of the reasons buying the FTSE 100 rather than buying something like China directly or Hong Kong is called the China chickens trade, because the FTSE 100 has about 20 to 25% of its exposure in Asia.
Why is it called the Footsie? What is this Footsie term?
So it's the Financial Times Stock Exchange 100 Share Index. It was established in January 1984. Seems like it's been around a lot longer. It's about the same time Chris and I have been in the market. So, well, Chris has been there since the beginning. I only came in the late 80s, but there we go. Over the long term, the returns since the FTSE began has basically returned between 7 and 8% annualised each year.
Oh, that's all
so
right.
that's pretty good.
Seems pretty decent to me.
Yeah.
As chairman of the board, that seems fine.
Of that, about half of it comes from the dividend within the FTSE 100, because the dividend of the FTSE 100 is renowned the world over for being one of the highest available dividend yields. So like getting your interest on a loan. But the FTSE 100 pays about 3.5% in terms of dividend. That's very good. And it's the biggest in the world of the major indices that are out there.
Bigger than the US?
Certainly, it's about double what the US pay.
Wow.
But that's if you're after income. And that, I would argue, is one of the failings of the UK. But there we go. We'll come on to that later. The mid 250 has delivered a little bit more than the FTSE 100, actually. It's delivered between 8.5% and 9% over the same sort of period. And the small cap has actually done the same as the mid cap, give or take. In fact, in some years, it's done better because from time to time, they have big bursts of performance. So the UK as a whole has done 7 to 8% over the years, but that compares with the S&P 500 of about 10.5%. NASDAQ, which we know is their tech and growth index, is about 14%, and then the US small caps have done about 7 to 8%. So the UK is sort of doing what the US small caps have done over the years, a bit less than the S&P 500 and the NASDAQ. Driving a lot of stock markets is something that we need to probably explain a little bit. They're called factors. They're the distinguishing features, if you like, of not just a stock maybe, but a sector or a stock market as a whole. So there are many different factors. The most common ones are things like quality, cyclicality, value, growth, and defensive features. So value, for example, the ones that are most prevalent in the UK are a value factor. This is where companies look cheap. They seem very cheap compared to what everyone believes is their true worth. That's based on things like earnings or assets. And the idea is that these cheap stocks have a very good chance to, at some point, increase in price and go back to a higher valuation. But you often need a catalyst to that. Now, the UK has got many of these value companies in it, and we'll talk about that more in a minute. There's a growth factor. So companies that grow above the average. and above the global GDP rate. So companies that can grow their sales, their profits better than the average. And investors buy these because they hope that the value of the shares will go up more. They're not really interested in getting dividends, but they're interested in the growth side of it. And then you have companies that are income on the other side, people who just want to have dividends or a high income. Like the FTSE 100, as I said, yields about 3.5%. So it gives you a 3.5% dividend effectively. And that is basically more driven by sometimes what's happening in the bond markets and the valuations drive that. Again, the FTSE has a big amount of exposure to income.
Can companies choose which factors they have in it? For example, if CJ and I had companies, then obviously CJ is a value trade. I would be a growth factor. Can we say that's what we are, or somebody else chooses?
There are indices that do actually distinguish between the two, and they make a judgment, not for you to decide, but it's a bit like Donald Trump deciding someone, but they do it in a much more rigorous and fundamental way. And they will be looking at the revenue growth, for example, and the revenue growth has to be above average to potentially be a growth stock. If it's below average, then it may be a defensive or it may be a values company. But you can't just say, I'm going to be a growth company.
I mean, in the simplistic version, you might say, are the profits going up by X% each year? And if they go up by 15% a year, let's say, or 20% a year, they might be called a growth company. Whereas if they go up by 2% a year, they're probably not going to be a growth company, but maybe they pay bigger dividends. And so they might be called a value company.
So the main factors affecting the UK are value, growth, income, and defensive sectors. Now, defensive factors. And those are companies like British American Tobacco, Associated British Foods, who own Primark, Unilever, utilities and telecoms companies. They have very steady growth that isn't really affected by the underlying economy. They're just steady growers. They tend to generate quite a lot of cash, and they can quite often become both defensive and income companies because they generate lots of cash with not very much growth, and they give the cash back to shareholders in the form of dividends. So it tends to be higher income stocks in that sort of area.
So we said there's no tech companies really in the UK. What do we have then? What's the index dominated by?
So the index, the top 5 sectors are financials, which is banks, insurance companies, etc. Consumer staples, which is, companies like sort of Unilever, as we talked about now, British American Tobacco, etc. Now, financials account for 23% or so of the entire FTSE 100. Consumer staples are about 18%. Below that are industrials. Now, industrials, you might think are a bit more cyclical, but actually in the UK, about half of that industrial sector is British Aerospace, or BAE Systems, and Rolls-Royce. And now they are long order books, steady business year in, year out, and they don't go up very much. So they're actually probably a bit more defensive and value orientated than perhaps some of the others. Then the other big sector is healthcare, which we know has got the companies like AstraZeneca and Glaxo in it, and energy. So that's obviously sort of BP and Shell. And energy is 11%, healthcare is about 11% too. But those 5 sectors there, I would say that financials are considered value.
Okay.
Consumer staples, defensive. And industrials, value. Healthcare, defensive. Energy, value.
Right.
So I've not once said the word growth in there, have I?
No.
And the trouble is, I will then go through the top 5 sectors in the US very quickly. Information technology, that's growth. That's 31% of the S&P 500.
And that is tech, really, isn't it?
Exactly. Financials are about 14%. Well, their financials are slightly different. They're quite exposed to stock markets because they have big investment banks like JP Morgan, Goldman Sachs fall into that category.
So the FTSE, you're talking about Lloyd's and you're talking about NatWest, whereas in the US, you're talking more Goldman's and Bank of America.
Yes. So they're more linked to how the stock market does, potentially.
Okay.
And then there's consumer discretionary, which, by the way, in America includes things like Tesla and Facebook. So that's about 11% of the market, and then communication services and healthcare. But, those are much more growthy sort of areas than the FTSE, as you can see. And yet those top 5 sectors both account for about 3/4 of the entire index. So just top 5 sectors.
Well, it's obvious then. You surely invest in the S&P 500. Why do you bother with the FTSE at all?
Well, I ask myself the same question every week. So the FTSE 100 has about half of it is what I would call value. And the S&P 500 is only 25%, so about a quarter of it. income in the FTSE is very important. About 40% of the companies there are what you might call income stocks. In the S&P 500, it's just 15. There's only about 15% of the entire FTSE 100 that I might call growth. In the S&P 500, about half the entire index is what you call growth. And then this quality defensive side, about 35% in the FTSE and about 25% in the S&P.
Now, it's been noticeable over the last year and a half, as those yield curves have gone from this funny inverted shape to a positive, banks in the UK have been fantastic.
Really great
Right?
investments.
And FTSE has done better this year. Now, don't get me wrong, FTSE's done terribly against something like the S&P over 10 years. I mean, it's done all right as an absolute performance, but as a relative performance, it's underperformed the S&P 500 in the US massively.
Yeah.
But this year, it's getting some of that back. So firstly, I would say financials are being re-rated. Anywhere I go and I talk to people about the financials being re-rated, and this is with very important bankers of the past and people who are dignitaries of today, they always say, oh, rubbish, banks are useless. And they've been short of them forever because of what's been going on. And now they're starting to lose money. So when I say short, they haven't owned them in their portfolio. And now they're going up a lot. And they're now saying, oh, maybe I should buy some of these. So firstly, the banks.
Yeah, but Barclays is up 150%, NatWest up 100%, even Lloyd's is up 75%.
Correct.
There is another big driver to these banks, which is important, which is debts, bad debts. If the economy is going into recession, banks are at the front end of that. People don't pay their mortgage, they don't pay their credit card, they don't pay their loan off. And that the bank has to write off that loan, if you like. So during bad economic times, banks are pretty poor investments because they're having all these bad debts that they're having to absorb year in, year out. Now, when they're cutting interest rates, like they're doing at the moment, we've seen that in the UK for the last few months, that means that the pressure on someone paying their loan or their credit card or their mortgage is easing. So the number of bad debts they get reduces. And that is one of the reasons bank profits go up, because they're not having to put as many bad debts through. And that's a very positive thing. Now, if the economy starts really going nicely and interest rates stay low and the yield curve, as Chris says, stays in the shape that we're talking about, that's a great environment for banks.
My second point for the defence is that the UK has been an underperforming market for a long time. Everybody knows, and it's very cheap in that sense because it's full of value stocks, as Mark has said so very clearly with terms of this factor analysis.
When you say cheap, you just mean that the number that you buy the FTSE at is low? What does cheap mean?
Relative to other markets, when we look at its price-earnings ratio, when we look at the number of comparative statistics, it's cheaper. The numbers are lower in the UK than they are in other markets. Now, my belief, and I accept this is my belief, and it is not shared by most people, is that they will not, they know growth is important. They will not slap on a huge amount of taxes. And so all the bad news that's being discounted by the market, taxes are going to have to go up, it's going to be terrible. There'll be relief, go back to expectations, as Mark has talked about before. The expectation is that taxes are going to go up a lot. If they don't go up a lot, that may be time to push the UK market upwards. Because if they do put taxes up, it's a cheap market, but it can stay cheap for a long time.
The interesting thing is the small cap in the US, the Russell 2000 index, as it's called, is up about 6% this week. And it's going up. These interest rate expectations, that the interest rate cuts are now beginning to be built in, and the confidence in those cuts coming through has been built in. At the same time, Trump is bringing a lot of manufacturing back into the US. That's going to help the small and mid-sized companies in the US hugely. And that index is beginning to move. Now, we have to watch that very carefully, but it is coming off a low base because the Russell 2000 has been a pretty poor performer for the last couple of years. So if this gains credibility, then again, we might be able to put some money into the Russell 2000 if we really believe that interest rates are going to come down more than people expect. And that domestic economy in the US, driven by Trump's getting manufacturing back to the US, making America great again, will actually help that index more than perhaps some of the others.
Mark's highlighted that the UK has its attractions, but they're not attractive in the global scheme of things at the moment. There's cheapness there, but is there the catalyst to bring that cheapness out?
If I can take that one stage further, we've got two coffee shops next to each other, right? And one is very fancy. You get the macchiatos and all the
Sorry, what are they?
The marshmallows or whatever, but that costs currently £12 to buy that coffee, the highest that traditionally it's been, and that's the US market at this moment. And then you've got a nice little calf next door, does a great coffee, and that's only £4. So some people are very happy to go and buy the fancy stuff. The growth factors that you've proved are much more interesting. But at some points, it is the right time to just go to the nice little calf.
When the economies are tough and there's recessions, the UK tends to do better, right? And it goes back to your coffee shop analogy. You're not going to spend £12.50 on a macchiato with a marshmallow on top of it, with a funny leaf on the top. You'll trade down, as it's called. You'll go from the £12.50 coffee to the £4 one. And that's what happens during recessions. People trade down. They don't spend as much money on food or expensive clothes or going out. They come down. Now, that's when the FTSE 100, as a defensive, high-income, high dividend-paying index, does well. So since the FTSE 100 was established back in January 1984, there's only been 4 distinct years where the FTSE 100 has outperformed the S&P 500. One was in 2008 when we had the global financial crisis.
Right.
And that's because we had much higher exposure to defensive sectors like Unilever, big dividends paying companies, rather than the US, which is heavy in tech. All the banks did badly, including the UK ones. Most of them went to zero, a lot of them. 2016, when Brexit happened, the Brexit broke happened, sterling, if you remember, fell 20%. When 80% of your earnings come from outside of the UK, they're benefiting because the dollar effectively went up 20%. So the earnings per share of those companies went up. And even though the stock market went down, the overall thing was there. So actually, the FTSE did, 13, 14% that year, and the S&P only did 12%. So it marginally outperformed. And then the last time was Russia-Ukraine, where basically we had massive inflation because Russia invaded Ukraine. The oil price nearly doubled. Commodity prices went through the roof. And the FTSE 100 is full of mining companies and full of energy companies.
And Rolls-Royce and British
aerospace,
and
defense
BAE,
companies.
Yeah.
Defense companies, absolutely.
Okay.
In conclusion, then, we've got a market that we all understand is cheap and has got some factors which are attractive. But it's all about that catalyst. What's going to make those factors come out? We've solved that a bit in our portfolio by having 10% in the FTSE because we recognise it's got some attractions, but it's quite low weighted. We need to see when the budget comes out whether there's some encouragement. If there is, then maybe there'll be a fight for maybe where we put some of that extra money that we saved at last week's meeting. Remember, we put 20% in short gilts to wait and see what happens. But it's too early to do that now. So no change to the portfolio is ensued.
Wonderful. Right. One of the questions that we got from a viewer. Well, first of all, he really enjoys the podcast. He thinks that the 2 older gentlemen really know what they're talking about. Not sure what he means there. And but he does have some money sitting on the sidelines that he wants to invest. He just didn't know how to start. So how do you open an account and what do you do from there? Well, the first thing to do is to go into the show notes below where you're listening to this podcast or watching on YouTube. And there you'll find a link to help you open an account. You go through the account opening process. And then, of course, you fund the account. You send your money through. And you can choose whether you would like a stocks and shares account or an ISA, which is an individual savings account where you don't pay any tax on the gains or the dividends. Or you may want to manage your pension yourself in a self-invested pension plan. That's a SIP. Those options are all available to you on the website. As I say, just click on the show notes below. But of course, other platforms are available as well. You have a Google, you can have a look around. But then there is an Art of Investing watch list. The watch list will detail all of the ETFs that we have included in our model portfolio. But there's also other watch lists, popular stocks, popular markets, other ETFs that you may be interested in, all depending on your age, on your risk appetite, and of course, your own feeling of how markets are going. Maybe a little bit more gold, a bit more copper. It's all down to you. That is the art of investing, putting not just the expertise that you hear on shows such as this, but also your own feelings about the world. Gents, that was the question from Matt Carter. But what if more of our viewers have questions? Where should they write to?
The Art of Investing at IG.com.
Fantastic. Almost as good as your chairmanship this week. Right. Thank you very much for joining us on this episode 6 of The Art of Investing. Boy, time goes quick, doesn't it? Tune in next week to find out how the portfolio has performed. Are we going to get a pullback? Or is Spice's bull market going to continue, especially in the US? Please give us a like, a subscribe, and a follow. And send us your emails, comments, or if you think we're barking up the wrong tree, you don't like the model portfolio, what amendments would you make? We're very keen to hear them. Gents, we'll see you both next week.
Thanks.
Cheerio.
Looking forward to it.